It is time for Consumer Confidential on this Friday with David Lazarus.
You know, every time I see the camera swooping, it's like Red 5 going at the Death Star.
Yes.
Star Wars reference, kids.
And it'll miss.
Did you bring some sound effects with you
Pew,
today?
pew, pew.
Yeah.
But, you know, I didn't want to get too technical.
Well, this is concerning news about the Silicon Valley Bank going bust.
It's a big deal. In fact, this is the biggest bank collapse since the 2008 financial crisis. So that kind of puts a feather in that cap. We're talking about Silicon Valley Bank. It went bust today as depositors rushed in to try to pull their money from the bank because it's a heavy tech lender, and somehow word got out that these guys are very exposed to dodgy tech companies, and suddenly people said, why would I get my money out? The word you're looking for here is bank run, and that's exactly what happened. And as the bank run gathered steam, the Federal Deposit Insurance Corp stepped in, took over and assumed control of nearly $175 billion worth of customer deposits. Okay, what do you need to know about situations like this? First of all, thankfully, they're not that common, so there's that. But if there is a run on a bank, if your money is in any way endangered, if it is an FDIC-covered bank, which almost every major bank is, you are covered up to $250,000. So that's good right there. Beyond that amount, you get in line for whatever other funds are available for disbursement, which typically comes after the FDIC either sells off the bank or starts selling off assets. This sort of deposit insurance is a big difference between normal banks and cryptocurrency exchanges, which have no relationship with the FDIC, have no deposit insurance, and if you're going to get any sort of compensation in the event of a collapse, it's only because the cryptocurrency exchange is doing it out of the goodness of its heart. Keep that in mind. You are very, very exposed. You know, it's like that scene in It's a Wonderful Life when there's a run on the bank and then Jimmy Stewart has to explain to everybody how banks work, how your money's in Jim's house and your money's in Joe's house. Well, in reality, people don't really think of it like that, and that's exactly what happened to Silicon Valley Bank. They weren't thinking about Jim's house and Joe's house. They were pulling their money out. And also back to that whole $250,000 threshold,
right.
I saw today that Roku, the streaming company, has nearly $500 million tied up in Silicon Valley Bank.
Oof.
That's not going to be recoverable.
No, not good. We need people to get the KTLA Plus app and support Roku.
That's what I'm saying.
That's what we're saying.
Yeah.
Speaking of apps, I am looking forward to a big game, Bruins-Ducks, tonight at 6. And a lot of the Pac-12 tournament has been on the Pac-12 network, which is only available if you have certain cable companies. So I still have cable. That's going to change.
Well, it looks like it's changing.
Okay.
And you're exactly right. Every time I talk to people about whether they should cut the cord, I always have to ask them first, are you a sports fan?
Right.
Because if you are a sports fan, cutting the cord doesn't make a lot of sense. Well, things are changing quickly, and that's because two of the major providers of regional sports, AT&T Sports Network and Sinclair's Diamond Sports Group, are running out of money, and they can't pay the exorbitant fees charged by professional teams for licensing rights to the games, and that's going to change things. Analysts say that's going to accelerate the move of sports content out of the cable packages and onto streaming platforms. Now, if you're a cable customer, well, that's great, because if you don't watch sports, that could potentially lower your bill because you're not watching those channels anyhow, and they're the most expensive channels there, make no mistake. On the streaming front, however, analysts say these entities would be so cost prohibitive that it's hard to see how people would afford them. The monthly fees for a streaming sports network would almost certainly be higher than anything now charged by Netflix or HBO Max or the other top streamers. How do you remedy that? It means the teams would have to be a whole lot less greedy and charge more reasonable prices for people to be able to view their games. And anybody who tracks the sports world knows greed and sports,
right.
They go hand in hand.
My first thought.
It'd be hard to pull them apart.
Yeah, I pay like $200 a month just so my husband can watch the Lakers.
Yep.
Nice.
Yep. Got to have the Lakers, got to have Pac-12 network. And it's so hard because if you want to, for example, a Dish network doesn't carry those specific channels. And I just am so arrested to this system of cable because I love watching the games.
It's absolutely a case where the teams and the broadcasters are going to have to come together and come to terms on how to keep these things accessible to people.
Interesting. It doesn't matter.
Hopefully they're listening.
March Madness is coming up, and I know productivity is about to drop, and I'm sure that'll be a story of yours coming up soon.
Any day now.